Hello, welcome to the Market Carver. I'm Adam Harder, Chief Investment Officer, along with Andrew Thrasher, Portfolio Manager. Thank you so much for joining us this week, where we're going to go over a few of the things we talked about in this week's investment allocation meeting. Talked about a lot. It was a good long meeting this week, Andrew, and I'm not going to go all the way into the weeds like we did in that meeting, but I will pull out some of the highlights. And we're going to take a look here at mortgage-backed securities. We're going to take a look at fund manager sentiment. And then the all important U.S. dollar. And just as a preview there to set that up, in case I forget to mention it later, so many times the dollar takes a backseat because it's slow, it's boring, but it can really be a wrecking ball or something that really makes markets. It can often be a pivotal point into which type of equities we want and which direction overall. So just to set the stage, stay tuned and catch what Andrew has to tell you about the dollar, because it could not be more important. But before we get to that, we'll start with mortgage-backed securities. I have to tease the important stuff so we can keep them engaged through the bond stuff. But mortgage-backed securities, the reason it's become an interesting investment piece is that the Federal Reserve is something we've talked a lot about. And in fact, it was either last week or the week before highlighted the decline or the expected decline in the Fed's balance sheet, which simply means they have bought a lot of assets. Many of which are the mortgage-backed securities. And they plan to unwind and sell those. As they mature, they won't be reinvested, and it's possible that they will sell. So it's very difficult or challenging to want to buy something that a gigantic player like the Federal Reserve is actually on the process of selling. Well, in this case, what you have is a market that has really sold them off and created somewhat of an opportunity. And so what makes mortgages compelling is that they are, and when I say mortgage-backed securities, there's different ways you can buy them. You can buy what we call non-agency mortgage-backed securities, and those would be those that don't carry the either explicit or implicit guarantee by the federal government. But the much more predominant, when we say mortgage-backed securities, typically what we mean are those issued by Freddie and Fannie, which have certainly had their challenges, but carry what we call an implicit guarantee. It's always been presumed that the federal government would step in. And in 2008, the actions they took pretty much made it all but explicit that the federal government comes in and guarantees those. And that becomes critical to understand if there's a big pricing discrepancy between what you can get on a treasury bond, which is guaranteed by the government, and mortgages, which is guaranteed by the government. It can be advantageous to go ahead and grab that extra yield. And that's what we see on the chart here. We're going to throw up a spread. What we're looking at is two different measures. One is investment grade corporates. So the best Coca-Colas and ExxonMobils, the most high quality borrowers in the United States. That is the green line, or blue. I can't quite tell. I'm somewhat of color agnostic there. But that's measuring the amount of extra income that you get relative to treasuries. And the orange line is how much extra income you get in mortgage-backed bonds. It's pretty stable. It's not very exciting. Doesn't move a whole lot. There's generally a little bit of spread because even though it's guaranteed by the government, it's a little less liquid and it's not fully explicit. However, if we get to the past few months, what has happened is that spread has become gigantic. So one of the pivotal things that we have done in fixed income portfolios is rotated to that. Is even more so, a lot more so than you can get for taking on those high credit corporations. So even though we've got a Federal Reserve that's getting ready to sell a lot, we want to go the other way and actually own them. There are other reasons too, but I will spare you for those. Moving on now to fund manager sentiment. So fund manager sentiment, we look at sentiment a whole lot of different ways, and Andrew's got a variety of different ones, and I'll let him cover why this B of A survey is important and what it means to us.
Well, I don't know if this will be as exciting as mortgage-backed credit bond spreads, but I'm gonna do my best. Well, here we're looking at different. I'm just kidding. Here we're looking at a sentiment survey done by Bank of America. They take a poll of a lot of fund managers, think mutual fund managers, and they ask them how much of their portfolios are invested in equities versus cash. And obviously that's going to go up and down along with the stock market. Traditionally, we would expect when the stock market's down that we're going to start seeing fund managers have less exposure to equities, naturally so. But when this starts to matter is when we start hitting extreme levels, whenever it's really, really high that we see they're loaded to the gills with equities, and then on the opposite side when they're basically abandoned equities. And we're kind of seeing that ladder right now. We're actually at one of the lowest levels. You can see on this chart, the circle on the far right, that marks July 2022, that we're one of the lowest levels of being overweight equities within their funds. And so this is the lowest level since actually 2008. And you'll see there the other circle, October 2008. And a lot of investors and a lot of commentators are saying we're at peak bearishness. Sentiment can't get any worse. If there's anything the market's taught us, that sentiment can always get worse. If you were around during the financial crisis or during the dot-com bubble or any of kind of the tumultuous times, the COVID crash, that things can always potentially get a little darker than we expect. What's important to recognize is that sentiment often leads price. When we're in these large longer term downtrends, that we start seeing sentiment will bottom, we'll see that peak level of bearishness historically will bottom before the market does. So when we think back, take our time machine back to October 2008, if we were to look at a chart of the stock market, we would see the stock market did not bottom in October 2008. In fact, it bottomed a couple months later in March of 2009. So we had to see that kind of flushing out of sentiment, have everyone turn bearish, so to speak, back in October at the end of 2008. And then we started to finally start seeing buyers come back in. What do we need to get the trends to go higher? You need people buying stocks. And so to get people buying stocks, sentiment has to improve. And so traditionally, we'll start seeing sentiment start to increase. That bearishness is not as bearish. And we'll actually start seeing a little bit more bulls. And that's what starts to kind of light the kindling to get buyers back in the market and trends going higher. So if we're starting to see a similar trend now, maybe we are seeing that peak bearishness, and then going forward, hopefully, we'll see that we can start seeing buyers come back to the market. Maybe we see possibly another low, or we see a little bit more whipsawing action within the market, but we start seeing people get less scared, and maybe we start seeing more buyers, and that's what we hope to look for in the coming weeks. Will that happen? Of course, we don't know, but we're always have our eyes open and trying to review the data as best we can. But right now, the bottom line, a lot of fund managers aren't big fans of equities. And for longer term investors, that's probably a good thing. That means there's potential for more buying interest, more buying pressure to come in the market and send equities higher in the long term.
Yes, sir. And so, as promised, moving to the ever so important United States dollar. And so, if you happen to skip over that intro, the dollar means so much. It can influence actually inflation. It can influence economic growth more directly to equities. It can tell you which sectors are going to do better. It can tell you whether you want to be domestic or international. So many implications. And I've really found this fascinating on Monday, Andrew. But if you wouldn't mind, walk us through where you see the bigger picture context for the U.S. dollar, which has been, for all the questions and all the concerns we have about the dollar getting weaker, it is the strength that has been the bigger concern. So take it away.
Very true. And so what I shared on Monday said this is the key I think to the market right now is really watching the trends in the dollar, and it's been very strong lately. So we're going to look at three different charts here. We're going to go back in history twice, and then we'll look at the current market. First, we want to look at that dot-com bubble when that burst back in 2000 through 2000. The market finally bottomed a couple years later. We have that time period here on the screen now. So on the top panel, again, we have the US dollar. On the bottom, we have the S&P 500. And we can see is that what we want to look for is common patterns within the stock market for when we have these counter trend rallies or when the market starts to show strength. And we want to start looking for, are there any good signs that say, hey, this is a good time. The market's finally bottomed. Maybe we can start getting interested in equities again. And the dollar can really help with that evaluation. So we can see when we did see these, what turned out to be just brief counter trend rallies, these pops in the stock market during that protracted bear market after 2000, we actually saw the dollar strengthen during those periods. Not a good sign for equity owners. And so each time we'd see the market go higher, it was accompanied along with the US dollar also going higher. until that trend started to change at the very end of the bear market. When the market was getting ready to start bottoming, we saw that dollar start to depreciate. The dollar started to go down. And that helped give that signal to equity investors to come back to the market. And we finally saw the market bottom, as you can see on that chart, kind of in that consolidation period in 2002, 2003. Now let's go to the next chart. Let's look at the financial crisis. We can see the very same thing. We'd see these rallies in the stock market, as short-lived as they may have been, and what came with it was a strengthening dollar. Each time the market tried to bounce higher, buyers tried to come back in, the dollar would go up. And then finally in October, we saw the first kind of cracking of that, to where the market rallied, and what the dollar do? It actually went lower. Wasn't enough strength to get a final low in the stock market, but we saw the market then roll back over into March 2009, and the dollar again began to break and go lower, and it continued to go lower. And finally, we did kind of have that fever break for the bulls, and the market was able to advance. We had that final bottom in March, and it was associated with a weakening US dollar. So now let's see, where do we stand today? This last chart's going to look at our current market. So we had the market peak kind of as we ring the bell for 2022. The market peaked, and we've been going lower ever since. We have had several counter trend rallies. Buyers tried to get a consensus and get the stock prices to go higher, and these brief pops in the stock market, you can see on the bottom panel, was associated again with the rising US dollar. And so we saw it back in March, dollar kind of advanced. We saw it a couple of weeks ago when the market tried to advance and the dollar continued to move higher. Now we have this most recent pop in stock prices. And what's the dollar done? It's done actually a little bit of both. Always want to keep us on our toes. We saw initially a move higher in the dollar, and then last week it started to kind of pull back a little bit. Now we want to see longer term trends. It can't just be over a day or two. We really want to see the dollar start to come back down. Unfortunately, this week we're not seeing that. Unfortunately, today we've actually seen the dollar pop back up. It's essentially gained all of what it gave back last week. And so we're still seeing a strong US dollar. Investors are still using that as kind of a safe haven out of a lot of their foreign currencies. And so that's telling us that maybe there's just not enough risk appetite, not enough bullishness in the market to get equity prices back higher. And we're seeing that as we record this video on Tuesday, with the market continuing to be a little bit weaker. So going forward, one of the things we really want to keep an eye on is the dollar getting stronger, or is it getting weaker? If the dollar actually starts getting weaker, that may be one of the signs we look for. We obviously want to see a composite. We want to see a lot of bullish signs. But one thing we want to look for is the dollar getting weaker may tell us that it's a time to start increasing some equity exposure, looking for more risk-taking type opportunities. And maybe we'll see that in the next couple weeks. But that's one of the key charts that I'm watching day in and day out. And I know something Adam keeps his eye on as well.
Yeah, and in between now, recording this on Tuesday afternoon, and when we will send this out Thursday morning, is a pretty big piece of news. The Federal Reserve will be meeting and announcing. So when you're watching this video, that will have been decided. We will be very eagerly, not just watching the announcement. We widely assume what's going to happen from that, but more listening to the tone and the questions and the answers from the chairman, because that can have a gigantic impact on which way the dollar goes. It can continue its strengthening, or maybe they suggest some sort of a change. We don't know, but hopefully when you're watching this, we will have dug into that and know a little bit more. So thank you for sticking with us for this week's Market Carver. Always happy to have you. Don't forget to come in and see us for your family update, or for another interperiod meeting. A lot has certainly changed in the market. So if you would like an update, feel free to schedule your meeting, scan the QR code, or give us a call, 800-928-4001. And then don't forget that we have the weekly radio show over the airwaves in WIBC, or however you get your podcast. Thanks again, and have a great weekend.